Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house, coming to you from Palm Springs in the greater Coachella Valley area. You can see I'm a little bundled up today. We actually have some, what would be considered winter weather for us here in the desert. Had some, pretty crazy weather the last couple of days. I think the high temperature today is only going to get about 60. Of course, I know that's summertime temperatures in other parts of the country, but for here, that's pretty chilly. And we had a terrific, just tremendous windstorm here the last couple of days, gusts over 60 miles an hour. So when you're in a community with palm trees everywhere, you can imagine all the debris from all those palm tree, what do they call them, fronds or whatever, that were all over the roads, and several trees were ripped right out from the roots and so forth. So we're expecting more rain this afternoon and into this evening, and so it should clear up over the weekend. The Olympics are, I think, on its last leg. I think are going to be winding up here in the next few days. It's been kind of fun to watch, and we talked last week about curling. I've been paying more attention to that than I ever have before, and I've kind of gotten a little bit hooked on it. I read this morning that I think our U.S. women's team is going to be heading into the semifinals, so that's kind of exciting. And of course, I've mentioned that we now are at a point where it's spring training for Major League Baseball. That gets me excited because I'm a baseball guy. And I will point out an event's coming up that's every couple of years, I think, the World Baseball Classic. That's actually a pretty fun event to watch, and that's where you have teams formed, both U.S. There's a U.S. team and teams from other countries, and I think it's from March 4th to March 17th. So if you haven't checked it out before, do so. It can actually be pretty exciting. Of course, when you got countries competing against each other, then that gets the excitement up there, and people, I think, get pretty intense. Now, not every U.S. Major League Baseball star is going to participate, but we'll have some good players on the team, and it actually can be a lot of fun. Again, if you're a baseball person, definitely check it out. And of course, the other thing I'm getting excited about is auto racing season is upon us. We had the Daytona 500 last weekend. That turned out to be a pretty good event and pretty exciting finish. And of course, what I'm looking forward to here soon is the start of the IndyCar season. I think they open in St. Petersburg on the weekend of March 1st. And then, of course, we've got Formula One. So a lot going on the sports stage. And one other thing I'm looking forward to, every year I go with a group of about 50 guys to Laughlin, Nevada, for the opening week of March Madness. This group of guys have been doing this for 29 years. I've been participating, I think, for about 14. So we go out there and we have a few golf outings. We actually have a bowling tournament, and the rest of the time we're in the sports book watching the games and betting on the opening week of the college basketball playoffs. So that'll be a fun event as well. So with that, let's go ahead and tell you a little bit about what's going on in the mortgage and bond market, the 10-year bond market. First, I'm going to point to our rate grid on our website. Really good looking numbers, folks. You can see right there, everything is in the fives. So this notion that we're stuck at around 6%, low sixes, not here at Mortgage Works. So everything you see there, other than the second mortgage, is all in the fives. And in particular, look at the FHA and VA down to 5.25, and then the 15-year fixed conventional 5.25. And the other thing I'm gotten pretty excited about is jumbo loans. You can see there a jumbo 30-year fixed. This is with a high credit score and a decent down payment, say around 40%, a 60 loan to value, 5.75, 30-year fixed. And then I think kind of the sleeper product for jumbo borrowers is that 7/1 ARM. That's fixed for 7 years. And look at that, 5.5% with no points. So anybody looking for a jumbo loan, of course, here in our market in the Palm Springs area, that's going to be anything over 832, 750. You should take a real hard look at the 7/1 ARM product. That's a really, really good rate, and I think it's something that would certainly be of interest if you need to finance the purchase of a home with a jumbo loan amount. Of course, out here in our market, crazy as it might sound, predictions from most market participants here in the desert, us mortgage folks, the realtors, will tell you that in the Coachella Valley overall, about 50% of the transactions are cash, which that's, of course, a good thing. Certainly on the realtor side, you don't have to worry about the whole loan process and worrying about your buyer getting approved. Of course, for us mortgage folks, we kind of don't like to hear that number. We would wish people would borrow money more often and not just write a check to buy that house. But nonetheless, that's the way our market is. So again, if you have a need for financing on a jumbo purchase, check with us. We can get you some pretty good rate on that jumbo loan amount. So with the 10-year bond yield, what we're going to show you is the 5-day chart going back to last Friday. You can see it got pretty elevated at the end of last week, and then we saw that nice drop going into early this week, in particular on Tuesday, when we actually saw that 10-year bond yield drop below 4.05. So that was pretty darn exciting. Now you can see it kind of drifted up later in the day yesterday and opening up this morning, but in a relative sense. Of course, one of the things about these charts is sometimes from day to day they're put out there where it's kind of relative. They kind of expand the ranges to make it look like there's more of a slope up or down than there really is. So again, on going into late Tuesday, we were a little bit below 405, got up to about a little over 410 early this morning, but you can see now that we're back down to 407. So that's really good news, and that's why, looking at our rate grid, why everything that we're offering right now is in the fives, and it's basically because of a direct correlation here with what's happening in the 10-year Treasury bond market. Again, this is not a a direct correlation, but it's a very, very good barometer, and that's why I keep an eye on it every single day. That's pretty much the first thing I look at when I get up in the morning, get ready for work, is always wanting to check and see where the 10-year bond yield is going, because that's going to be a pretty good predictor as where mortgage rates are going as well. So in terms of what's making the market move, pretty light week in terms of economic data points. There was really not much of anything early part of this week. Of course, last Monday was a holiday, or this past Monday was a holiday, President's Day holiday. So certainly most of us in the mortgage escrow title business were closed. But one, pretty good positive data point that came out, I think is encouraging for all of the bashing about how terrible the housing market is we saw some really pretty strong numbers for housing starts and building permits, up 6.2% in December. That's the highest in 5 months, going back to July of last year. So for all of the naysayers and all the woe is me and the moaning and groaning about how bad the housing market is, well, folks, there's to see that kind of increase, that kind of strength in housing starts and permits, I think is a pretty positive sign. Now, until tomorrow, there's really not much else happening in terms of data. We did have the initial claims for unemployment come out today. I don't have it on the screen here, but only 203,000. So that's more evidence that there's nothing happening in terms of the labor market collapsing or suddenly a bunch of people out of work. That doesn't seem to be the case. Now, I've heard some numbers that suggest that there's a sort of a decrease in employment, but apparently that's really more having to do with immigration and the fact that we have less employment as to immigrants relative to those who are native born here and so forth. So overall, though, I think the labor market is showing some pretty good strength, and when you couple that with the fact that the inflation continues to be pretty benign, I think that's why overall we have a pretty good economy. So again, a lot of the headlines suggest the economy is bad, people are unhappy, consumer sentiment is poor. But gosh, I don't know. I see a lot of evidence to the contrary. A lot of costs of things are down. Groceries are down, eggs are down. The favorite target about eggs. Gas is down. Of course, gas is down pretty much everywhere except for California. But I won't get into all that. But for the rest of the country, gasoline has been a really good bright spot. And of course, oil overall is so integral to so many products and services. The fact that we have gas prices down overall will trickle out to the cost of all kinds of goods and services. So again, I think that's a relatively good thing. And the other thing that came out today, I also don't have it on the screen, is the Philly Fed manufacturing survey came out very strong. So manufacturing seems to be up. The only other data point, and it's a big one, it's tomorrow. It's the personal consumption expenditures index. That's the Fed's favorite inflation target. The monthly number is forecast to be at 0.3%, a slight tick up from November when it was 0.2. But the year-over-year number for December is forecast to be right on target with what it was in November. So again, stable, no increase. So if that bears out, I think that'll be generally good for the bond market, which, by the way, if you recall, last week I said the CPI, which came out last Friday, could be a bit of a market mover. And I think I ended up being relatively accurate on that prediction, if you will, because the CPI last week was actually very benign. In fact, it was lower. And of course, it didn't really reflect in close of business on Friday. But again, coming into this week, you saw a big drop in that 10-year bond yield. And I think a lot of that had to do with the CPI number being, as they say, cooler than expected. So with that, I want to go ahead and get into our Q&A with Jeff. Jeff's going to come back on.
Hey,
We're going
Art.
to talk a little bit again about wealth creation as it relates to homeowners and renters. Hey, Jeff.
You're talking about the wind. I'm on the other side of the valley. You're in the Palm Springs. I'm in the La Quinta area, which is, I don't know, probably 8-10 miles away from another. The wind is absolutely howling here. So if all of a sudden you hear a crash and you see me missing, I'm going to go take care of whatever happens. So it is a little crazy. But anyway, I'm really into curling like you are. And one of those things, it's like, if that's all they're showing, I guess we get excited about it, huh?
Well, it seems like, I don't know, when you turn on the TV and kind of look at what they're broadcasting for the Olympics, maybe it's just me, but it kind of feels like curling has suddenly become sort of center stage. And I think there's a curiosity about it that many of us who watch the Olympics every time they're on really didn't have about the sport before, but it seems to have gathered steam. And there's a lot of interest in it that I don't recall hearing about or seeing much of in past events like this. So
yeah, I think it's pretty exciting, and it kind of ignites a sport that's been around for a long time, but like you said, never really been in the limelight. But speaking of limelight, this whole idea of wealth creation gaps don't exist between homeowners and renters. I got to ask you, is that true or false?
Well, no, and that's why we're going to talk about it. And yeah, when you look at that headline, and the reason we're going to do this is because we've talked about it before, but I wanted to talk about it again because I saw this on the news feed, and I'm like, how can you possibly say that? And again, yeah, the argument was renting and owning build wealth at roughly the same pace. Now, and in fact, I saw one other article here, I think just yesterday, where it said, yeah, Gen Z is now looking at the stock market as a way to build wealth, not housing. So there's this drumbeat about housing is a negative thing, and you don't need housing, and you can build wealth some other way. And I have argued in the past that intellectually, I don't disagree with that. You can build wealth without owning a home. But the key point has to be, is that actually bearing out to be true? And so that those who write these headlines and write these articles suggesting you don't need a home to build wealth, my word, I feel like they're just not paying attention to the data. And of course, I'm very data driven. At the end of the day, that's what I think you have to focus on. This can be kind of an emotional subject. And so that's why I wanted to go over it again. I don't want to get real preachy about it, but my word, the data just doesn't support this declaration that renter down the street can build wealth over the next 40 years just as well as a homeowner.
Well, as you said, you've talked about this in the past, and when you mention this thing about Gen Z, Art, I just want to ask you, to me, it feels like if I were putting my money in the stock market only versus my home, I have to pay a lot closer attention to that because of the ups and downs and dips and whatnot. And people say, well, just put it in a money market account, or in a mutual fund. Well, it just feels also like it's a little more than it is a home. I don't remember. I think you've mentioned in the past over tracking. There's only been 7 times that the market has ever not gone up.
Well, exactly right. I mean, if anyone wants to go back and kind of Google the median price of a home after the last 50, 60, 70 years, what you're going to see is a graph that's going to be generally sloping upwards. There's going to be a couple of dips. Of course, what is still ingrained in everybody's mind, almost like a brand that you put on cattle, where 2008 is so stuck in everybody's memory. that kind of, I think, kind of clouds thinking. But again, if you look at the history of home prices over many, many decades, it's a pretty impressive slope upwards, again, with a couple of dips here and there. So long term, I don't know how folks can conclude that it's just too risky or too scary, because the thing about housing, and of course, I'm in the mortgage business. I'm involved, involved with the Greater Palm Springs Realtors Association. What we're trying to focus on here is the fact that housing is interesting because it's an opportunity to build wealth while at the same time you need shelter. So it has a utility function as well as a potential investment function in terms of growing your wealth over time. And why why more folks don't recognize that and realize that they need to take advantage of that. It's something that I'm going to continue to talk about, because my mission is to get more and more people to realize that long term, it's really a way to address a couple of basic needs that you have as a person, as a family, and to build your future.
Well, I was going to say, you talk about this data drop information. I just want to point out what you're about ready to share. It says it's coming from the 2022 Survey of Consumer Finances from the Federal Reserve. So this is not an opinion. This is data. So you want to get into that?
I do. And yeah, the reason I wanted to bring this up is that, and I think we've mentioned it before, but the Federal Reserve, I think they call it a triennial basis, every 3 years, they do this study, and they call it the Survey of Consumer Finance or Finances. And so they last did it in 2019. The most recent study was released in 2022. Now, of course, that also will tell you, therefore, they probably are in the midst of doing the report now for 2025. And of course, it takes time to get released. I would imagine it'll get released later this year, which, of course, when it does, we'll have to bring that study into our program and see where the numbers are for 2025. But 2022 is a pretty recent number to look at. And so I wanted to go over some of the findings, because they're pretty jaw-dropping, really, and in particular in terms of whether or not our headline there at the top of the screen really bears out. And of course, as you just pulled up here, the median net worth of a homeowner was about $396,000. That's a pretty strong number. Now, any idea, you think, what the renters?
I can't imagine it being anywhere near that, Art.
Well, remember, we talked before that it's about a 40 times.
Oh, geez.
So, of course, for our viewers, maybe go ahead and pull up the bullet point. Yeah, look at that. 10,400.
Wow.
So if that doesn't get people's attention, I don't know what will. And the reason here is the difference is the data shows that despite whoever is of the opinion that wealth creation gaps don't exist, they're wrong. They do exist. And this study every 3 years has borne that out over and over and over again. And I suspect that when the 25 report is completed and issued, it's going to be the same again. So you have to deal with reality here. And if you're a renter, God bless you. If that's what makes you happy and you want to continue to be a renter, no issue with that. But if you really want to build wealth, then you've got to look at your personal budget, and you have to make a decision to reallocate your dollars in a different way if you want to get anywhere near these kind of numbers in terms of what a homeowner is achieving. Now, of course, let's talk about why that gap exists, because it's rather obvious once you kind of break it down a little bit, why such a gap between these two numbers. And again, the first one that you see right there, appreciation. When home values rise, equity rises, that means higher net worth. And it is true, a majority of that net worth of a homeowner is due to equity in their home.
Sure.
Nothing wrong with that, right?
Well, we've heard over and over where somebody said, like, I'll meet some people at the pickleball court, and I said, "Where are you from?" They said, "Well, we're from San Fernando Valley," or wherever they are from. And then what they said, "Well, we moved out here." And I just curiously will ask them, "Well, how did you sell your home, or what did you sell it for? And they said, wow, we sold this for so much more than we bought it for. We bought it for, 200,000 then, and now we sold it for $1.5 million.
Right.
Well, isn't that net worth the difference between those two?
Exactly right. I mean, that is real life proof of what's going on with these kind of numbers. I mean, how often do you hear about a renter in the San Fernando Valley who decides to move here? Are they moving here because they've been a renter for 20 or 25 years and they built up this wealth? They created this wealth just like a homeowner would, but they did it through alternative investments. So they're bringing this big bucket of money out to the desert to relocate and buy a home. Generally, that's not the case. Part of the reason why the Coachella Valley as a particular specific market has such a high percentage of cash transactions when it comes to purchasing a home are folks who are coming here basically to relocate. A lot of times they're retirement age, not always. And what they're doing is they already were on the path of wealth creation years ago. They built up that net worth because of the home they had acquired elsewhere in the San Fernando Valleys, San Francisco, San Diego, Seattle, all over the country. They sell that property, they capture all of that wealth. They come here and they find they can buy more house than they owned up there and have money left over to put in the bank. So that's why we end up having so much cash deals out here. For that reason, they're able to transfer that wealth creation over here in this market. And like I said, be able to do that and start off with a very good situation in terms of equity in the home, particularly if they paid cash and cash left over in the bank, because then what can they do? Diversify. Then you're doing both. Then you've got wealth creation from owning the home, and then you have extra cash left over from the previous home that you own where you built wealth, and then put that maybe into financial investments. So you're diversifying your investments, and you're going to accelerate your wealth creation even more.
Art, I have a question. We have a question from our audience. It's a little off topic, but it's very specific. I think it's a pretty quick answer. If you wouldn't mind taking it.
Sure.
It's from, it looks like Ed Duval. He says, do you underwrite and qualify borrowers before looking for homes so they know what the maximum purchase price would be, and so can write 10 to 15 day closing offers?
Yeah, we do. In fact, it's an interesting question because just yesterday I corresponded with someone who out here in our market was, we actually pre-qualified them to make an offer on a home. And actually the buyer is a realtor who I know and I'm involved with the Greater Palm Springs Realtors Association. And they ended up passing on a particular home they were looking at. I guess there was a couple of offers. They decided they didn't want to compete. So she was asking if she should go ahead and provide us the rest of the documentation that we had required to get the loan ready to go should their offer have been accepted. And so one of the things I suggested is to go ahead and send us the documentation, and then we can formally submit their application for what we generally call in the industry TBD underwriting. So what that means is we get an application, we gather up all the documentation that would be needed for the loan file. We can submit their application to a lender, get it formally underwritten and approved, and it's subject to only finding the house, appraising the house, and then getting the escrow and title information, in particular the title report for that house. We add that to the file. But when you're making your offer, we're going to be able to provide not just a pre-qualification, not just a pre-approval, because those are sort of murky terms. We can say, here is a written underwriting approval from a specific lender with the document, with the underwriting conditions. And you can see it's a short list. It's all about finding the house. And then once it's found, we appraise it, get the title report, and we can close. And that's a very good strategy to use, particularly if you're looking at a house that may generate some interest, maybe has multiple offers, including cash. This will put you on much better footing to compete because you've already 80% through the process of the underwriting process, and we can get everything approved except for finding the house, getting it appraised, getting the title report, and we can close in that period of time.
Right. Great question, Ed Duval. I appreciate that. And Art, thanks for stopping on that and answering that. Well, let's get back to why that gap exists. So obviously appreciation. So the home goes up, you get more net worth. What else is going on there?
Leverage, as it shows here, your return on investment. Because one of the things about when you're buying a home, you're going to make a down payment, right? Well, if you're a first-time home buyer, it can be as little as 3% down. FHA is 3.5%. Maybe it's 5 or 10 or 15, even 20. But the point is, if you're buying, out here, our median price is what, $600,000. Even if you're putting 20% down, you're buying an asset with a value of 600. You're only putting 20% of that value into the home to start with. So you're leveraging your ability to build wealth because you're not paying cash for it. So that's part of the reason why this gap exists. Do you have any leverage when you're paying rent to your landlord? No, you have none, because you're not paying it into an asset that you own, and that is generally going to appreciate. So you don't even have a leverage opportunity when you're renting. Of course, that's totally unlike when you're purchasing the home and owning it. So leverage is a key part of why the gap exists.
Well, I just have one kind of point on that is, like, when you talk about leverage, I remember years ago when I was first starting to invest in real estate, and we had the opportunity to take some equity out of our existing home, which you just mentioned, and we used to buy other homes. That really, someone said, well, you know what your ROI on that is? And I said, no. He said, it's unlimited because it's borrowed money.
Right.
So it was like, oh my gosh, well, I can't get that as a renter.
Exactly right. Exactly right. And, there's actually a lot of homeowners. We talk about the market's locked up. We got these homeowners with 2.5% and 3% mortgages. They've got a whole bunch of equity now from the increase in values from 2019 through the pandemic, and they're stuck. They don't want to trade that 2.5% mortgage to a 6% mortgage, or if you come to us, it's a 5 5/8 mortgage. But the point is, they don't want to move. Well, gee whiz, consider another way to build some more wealth. Borrow some money against all that equity you've developed. Buy an investment property, and the leverage is almost unlimited because you're using borrowed money to acquire another asset that should, on balance, grow over time. It's diversifying your leverage, your wealth creation through now multiple properties. Why in the world wouldn't you think about doing that if you don't want to sell your primary home because you don't want to take that higher rate?
Good point. Well, the third point there is forced savings. Talk about that, because this is a different feeling. Again,
it's a different feeling, but I think a subtle point that has to be made, again, when you compare your renter and you're paying rent, is that process forcing any savings that you're achieving? No, because again, you're paying rent for the utility of having a roof over your head. That roof is not an asset that you own. When you buy a home, and if you finance that purchase, so therefore you're purchasing it with leverage, how is the forced savings occurring? Well, because you're making a mortgage payment. Yeah, there's interest on it, but every month when you make that payment, part of that is going to interest. Yes, in the early years, a majority of it is interest, but you are chipping away at the principal. And as you do that, what is that creating? Forced savings, because you've got to pay a monthly payment for the roof over your head, for the utility of having housing. But by having a mortgage, not a rent payment, you're essentially creating savings, because over time you're reducing that mortgage balance every month. And then if you make just a conservative assumption, like we do on reverse mortgages, any reverse mortgage proposal uses a standard 4% assumed appreciation rate for the home, which I would argue, if you go back and look at the history of home prices in this country, that's a pretty solid number. Well, gee whiz. So, I got an average, and these are conservative numbers, an average 4% appreciation rate per year. And then you've got the forced savings of gradually paying down your loan balance. You put those two together, and guess what's happening? Equity is growing. And as it goes on year after year, that's going to start growing at a greater rate. And that's why you go back to those two numbers near the top. If you're a homeowner, you got almost $400,000 in net worth. If you're a renter, you're still stuck at $10,000 because you don't have the appreciation, the leverage, and the forced savings at work.
Well, one other point, and call me out if I'm wrong, but if I'm a renter and I'm paying to that landlord, am I not actually helping their net worth grow because I'm paying down their mortgage in essence? Am I not?
Exactly right. Yeah, you're paying for the benefit of having, again, the utility of housing, having a roof over your head, but you're paying it to a landlord. And of course, the landlord, in many cases, not all, a lot of them have the home is free and clear, but let's say they have financing on it. So yeah, they're taking your rent money and then they're using that to pay their mortgage expense. So that's forced savings for the landlord. And because they own the home, they're now enjoying that appreciation combined with the forced savings. So that's what's creating their wealth. And you, as the renter, how are you participating in that? Not at all, other than you're giving your dollars to the landlord to help them do what we're talking about here. So if you think of it that way, it's like, if you have any opportunity at all to afford and be able to qualify to purchase a home and get a mortgage, why in the world would you not do that? I mean, the data here, the numbers are compelling as to why. I don't know why most folks would want to be a renter when you have this opportunity. Now, again, not everybody's going to feel this way. And, again, God bless you if you want to stay as a renter. But for some of you out there, you really kind of take a harder look at this because there's an opportunity here you're missing.
Well, I'd love to at some point in the future, Art, because I know there's that, and I'll just call it a myth. It could be something different of, well, it's cheaper to rent than it is to buy. But then I look at this and like, $396 versus $104. Is it really cheaper to go that route? Because it seems like, well, if I pay roughly the same amount for rent as I do buying a home, except one is a forced saving that keeps the appreciation and the leverage that you're talking about here, that seems like a no-brainer.
Well, it should be. But the problem is most folks who are on the renting side, they kind of justify what they're doing. I think they try to create a rational argument as to why. Well, wait a minute, this doesn't make sense for me because, the average mortgage payment in the U.S. I think it's somewhere around $2,400 a month on average. Again, this is nationwide, so places like California that number doesn't compute, right? But you take that versus the average rent again nationally is maybe I would say $700-800 a month less. So you go, here it is. If I got to pay $2,400 a month to own, but I can only have to pay $1,600 a month to rent, why am I not better off renting? It's cheaper. Well, not really when you compare the other part that you're leaving out, the creation of the wealth because you're paying for an appreciating asset versus the lower amount you're paying where you aren't paying, you're not getting any asset and no asset growth from those dollars. Plus the fact when you're enjoying that lower cash out of pocket for renting versus owning, you're maybe not doing what you should be doing with that monthly difference to achieve what we talked about earlier, building wealth through some other means like financial investments. Most renters, even though, you can talk a big game, most of you just aren't doing it.
Art, we always seem to fall back into that whole thing about the COVID, the time of COVID where this happened. It seems like during that 2019 to 2022 ocean. Let's talk about that a little bit. First of all, what happened to the average net worth during this period?
Well, that's a good point. Some people would argue, hey, these numbers are not sustainable because of what happened from pre-pandemic through 2022. We all know that during that period, property values went up significantly, right? Yeah. So what happened as a result of that? Well, median homeowners net worth increased by about $141,000. Certainly a big part of that was that big jump in appreciation, certainly more than 4%, that was occurring during that period. You could say, okay, well, that was a one and done phenomenon. It was a 100-year pandemic. We're not going to see those kind of appreciation rates ongoing year after year. True. But consider if you were a renter in 2019 and you didn't decide back then that you should reallocate your dollars and try to get into home ownership, consider that you lost the opportunity, right? You didn't get an opportunity 141. Instead, as you show here, your net worth increased by a measly $4,000, right?
Ouch.
So, you can argue timing is everything, but I would say yes, but you don't want to time the market, whether you're buying in financial investments or housing. Again, housing is a little different. You need the utility of a roof over your head. So I don't think you should time the market, but you should get into the market as soon as you can so that when the next scenario, the next set of conditions like we saw between 19 and 22, you're there and you're ready to take advantage of that. When you stay as a renter, you don't get that opportunity. And so, yeah, why this big gap in net worth growth? And again, we just basically talked about it. Homeowners didn't work that hard. Yes, that's true. The key was you owned that home before this big run up between 19 and 22. You already owned it. You were leveraging your appreciating asset during this strong housing run. That's an example of positioning yourself for the opportunity. Why would you stay on the sidelines and not have the opportunity at all? Because even when it doesn't run up that substantially, even again, we talked about the 4% average appreciation rate. And if you're paying down that mortgage through the forced savings, you're still going to achieve some significant growth over being a renter. Maybe not 141,000 in 3 years, but it certainly could be maybe half of that or 2/3 of that. That's not anything to sneeze at, particularly if as a renter, you're going to still be stuck in that 4,000, 5,000, 10,000 range.
Well, before we go to the next point, I just want to hit you right on this idea of, you mentioned about the millennials, or I think you said Gen Z, maybe
Gen Z.
said, hey, they want to go into the stock market. I'm thinking in a 3-year period, and you increase your net worth by $141,000 in that 3-year period. That far outweighs any of the statistical data on average of someone who invests in the stock market. Now, maybe I'll be all wet, but I don't think so.
I think you're right. Although of course, you heard recently our president suggested that he thinks the stock market could go from 50,000, where it's hovering around now, to 100,000 before he leaves office, in terms of the Dow. But that's pretty lofty. I don't see it doubling in 3 years. That's not something you see in the stock market very often, if at all. We had a pretty strong period between 2019 and 22. What's going to be interesting in that regard is when the Fed comes out with their study for 2025, I'll be real curious to see how these numbers bear out. Will it be another 141,000 for homeowners? For renters, I think it will still be in the 4,000, 5,000, probably not more than 10. The growth for homeowners may not be 141, but I'm going to bet, even though folks have said, oh, wait, home values have started to subside, they're moderating, they're plateauing, it's still going to be a drastic gap between the two. And that's, again, why you should consider home ownership, even when it's not going to be like that 19 to 22 period.
So you have some messages for a couple of groups out there, have a little bit different. A lot of times a realtor will just be selling a home,
right.
But you'd like to have them think something different. What is that?
Yeah, if you pull up the next bullet point, I'll share that with you. They need to understand you're not just helping someone buy a home, you're helping them reposition their balance sheet. And again, that's maybe a little bit more complicated subject to think about, but that's really what a renter versus homeowner, that's the difference between the two groups. When you look at a renter's balance sheet, there's not much there, right? When you're a realtor, and I think the better realtors out there know this, and some of the realtors who watch the show, I think, are very tuned into this. What you're doing when you're helping somebody get into home ownership, you are strengthening their balance sheet. That's really important for a family long term, especially if you have kids and so forth, generational wealth, and then the ability to pass that on to your family once you pass. So, realtors should all know that's what you're doing. Why? It's not just the simple act of you're selling a home, you're getting a commission, you move on. You're serving an incredibly important role to help families achieve home ownership, strengthen their balance sheet, and position themselves for generational wealth that's going to provide benefits to them currently, their family currently, and their heirs for many, many years to come. So I can't underscore that enough. Many realtors out there are aware of this, but I think even more need to be aware of this and realize this is a big part of their mission.
Yeah. And then if you're a homeowner out there, if you've been hesitant, what message would you share with them about this?
Well, I guess what I would say is you got to have a kind of a serious talk with yourself about repositioning your balance sheet, reallocating your dollars. Everybody's most folks have got a job and they got a certain number of dollars coming in. Now, granted, not everybody's making as much money as they want, but what's kind of remarkable about folks in general is, especially if you're on the renter side, is you're you're concerned about, and we're going to talk about this in a minute when we go into our next subject, they get concerned about, my gosh, the expense of owning a home and that mortgage payment is so high. I just don't think I can afford it. I don't want to live for my mortgage. And then they also get hung up. What have we been hearing about for 3 years after the pandemic and rates went up? Well, I'm going to wait. I'm going to wait for rates to come down. I'm going to wait for home prices to come down. Well, rates have been coming down in a sticky fashion. Yes, we're over 2% lower than we were, 2.5 years ago, but we're still a long way from 2.5 and 3. And I don't think we're going to get there in anybody's lifetime. Certainly not mine, and probably a lot of us. So why would you wait to try to time the market when all this data suggests you shouldn't wait? You need to reallocate your dollars, reallocate your balance sheet, and position yourself to get into this asset, this appreciating asset, because it's going to give you really kind of 2 or 3 really good benefits, which I want you to go ahead and pull up now. Housing isn't just about shelter. It is in the sense that you need shelter, but when you need shelter, why wouldn't you consider it's not just shelter? It provides you that, but it gives you structure, it gives you leverage, and it gives you equity. That is so much more beneficial to you and your family versus just renting. And the Federal Reserve data makes that entirely true. And if you look at those numbers, you got to figure out how to make it achievable so you can participate in these benefits, because over time ownership really does matter.
It reminds me, Art, and then we'll go to the next topic, is, whenever we're going to make a big investment like owning a home, is sometimes you have to say, well, we may have to tighten our budget in other areas or make decisions on not to do certain things as often as we have, whether that's eating out, that's going on vacation, whatever, because we are investing in the future, not for that immediate gratification. Is that a fair thing to start thinking about when you're a homeowner? Is you're more of I don't want to say sacrificing, but you're reallocating your attention and your dollars?
Yeah, I think it's true. And again, I don't want to have folks feel like I'm preaching to them, but when you're younger and you're a renter, I think you have to embrace the need to reorganize your priorities and reallocate your dollars. And you could argue it's a little bit of a sacrifice, but when you consider how you're spending your dollars now and what you're getting in return versus how you could take some of those dollars, reallocate them towards something like owning a home that's going to build this wealth creation over time, I don't know why you wouldn't take that to heart and realize, my gosh, if I'm interested in my future at all. And of course, when all of it, Jeff, people may not realize this, but you and I were young once, right? And,
right.
When we were young, I can think of times when I wasn't thinking long-term into the future. And as you get older, you start to realize that you maybe should have done that more and so forth. And so my advice to folks who are younger and the Gen Zs, millennials and so forth, although millennials are starting to get up there, you've got to start thinking about that earlier in your life, because if you don't, when you get to be older, you're going to go, oh, shoot, I should have paid more attention to this when I was younger. And now I've got to hurry up and catch up. And that could make the hill a little bit steeper to climb to get where you want to be.
Yeah, Ed just shared this. He said, I have to believe all of us that were first-time home buyers said, how am I going to afford the actual cost? But the alternative is building a landlord's wealth and not yours. Great point, Ed.
Very good point. Yes, sir, Ed. You're exactly right on that point for sure.
All right, so let's get into the next one, because you brought it up about, what do you call it, DTI?
Yeah, DTI, interesting issue. And why I wanted to touch on this real quick is I read an article in Mortgage Professional America. It's a trade publication. And someone wrote an article about debt to income ratio. That's what DTI is, and why people should care about it. And, what it was going through was a little bit of the history of debt to income ratios and getting people qualified. Back when I started, the debt ratios that were used to qualify people were lower. The old rule was like somewhere in the range of 29 over 36, 29 being your housing ratio, 36 being your total debt ratio, total debt, including car loans, credit cards, student loans, and so forth. Then it kind of moved up a little bit to 33, 38. And same thing, 33% being your housing expense, including taxes, insurance, HOA dues, 38 again, total debt, including the consumer debt payments that you're making. Of course, we had the crash of '08 when people were getting mortgages when they had no business getting one because they didn't have the income to service their payment. Then a new kind of landscape came out of that with the CFPB where the target ratio, total ratio, then got moved up to 43. And now for a lot of programs, most conforming programs, you can go up to 50% on a Fannie Mae Freddie Mac loan. FHA, VA, you can go higher than 50% on a total debt ratio. But of course, what that does, as a bullet point says, it can leave you as a homeowner feeling like you're one speed bump away from trouble. And so that is an issue with some folks who are on the fence about buying because they may already be in a situation where if they're going to qualify, they're going to qualify with these higher total debt ratios that they may feel a little bit uncomfortable about because if one thing goes wrong, the house of cards, if you will, starts to collapse. No pun intended. But, that's what this writer of this article was pointing out is that this is where we've gotten to. And this even more calls for why, as a potential home buyer, you've got to rethink how to reallocate your dollars and create a stronger balance sheet so you're better positioned to stay away from that one speed bump, causing a bunch of problems.
I was always brought up under the situation. It wasn't always easy to do, but to say, live well within your means. And so you could create savings, so you could do things like that. It seems like it's very easy, especially because we're just being bombarded every day by, hey, buy this new cell phone, buy this new car, no money down this, no money down that. It seems like it's kind of easy, Art, to get into that, holy crap, I've got to, in this terminology, my DTI is pretty high right now.
Well, right. In fact, we're going to show you, as I just pointed out, mid 50s DTI. What does that mean? Well, if you find that you can qualify for a mortgage, the housing expense for the mortgage, principal and interest, taxes, and insurance, plus your other consumer debt payments, you can end up getting approved when your total debt ratio is over 50% of your income. It's more than half of your gross income. And of course, people don't realize we're qualifying you off your gross income. And then they're going to say, well, wait a minute, my gross income isn't what I bring home, especially in California, right? Your bring home is a lot less. So then when you look at it that way, it's even worse, right? Mm-hmm. So when you look at that, it can feel like a high risk move. I think that's why some people are hesitant to buy, because of the fact that when you add that mortgage expense to what they're already paying, it gets a little bit uncomfortable. And you start feeling like, how am I going to make this work?
Well, first of all, and you've talked about this before, but how did we even get here to these higher numbers?
Well, it's a combination of a couple of things. One is, there are more low down payment options out there. And of course, there's a direct correlation. You put less money down, your mortgage expense is going to be that much higher. I mean, that's obvious, right? The other thing is, realize that the ball has moved in terms of what the industry considers you're able to be qualified for. But then there's the everyday reality of, living and having the dollars to cover all this stuff. So qualifying for a mortgage to buy isn't the same necessarily. And some prospective buyers who have said, I'm not going to do this yet, would argue, hey, you're qualifying me for this. That doesn't mean I can afford it. I mean, I've had many people tell me, hey, you know what? Well, I tell them, hey, look, on paper, I can qualify you for a $1 million home. But then they'll say, well, okay, duly noted. But that doesn't mean I can afford $1 million home. I'd rather deal with a $750,000 home that you'll say I'm well qualified for, but I'm going to feel like that's more affordable for me, because I'm not spending as many dollars every month out of pocket in order to have that shelter over my head, as well as the opportunity for the wealth creation. So that's really what you have to kind of understand, is how we got here with these higher debt ratios to get more people qualified. But at the same time, that's not to say that means you can necessarily comfortably afford those numbers.
Well, it seems like, I think it was last week, you were talking about a couple that you had helped, and it was a situation where they had a lot of income, and the home they decided to buy was well within their, in other words, saying, hey, I can qualify for this, but this is where where it's really affordable. And so they weren't being married to their mortgage. They were saying, "Hey, we have this much capacity, but we've chosen this home because we can still enjoy life and pay for our home." Was that kind of the direction that you helped them?
Well, I'm going to give you a little bit more backstory to that.
Okay.
So that was the conversation we had when I first encountered them and pre-qualified them, or at least gave them some preliminary numbers going back to last summer. And I thought to myself, they're being conservative as to their price level that they want to qualify for because they have very good income. But we didn't really get formally into the full process because it was too early. They made it clear they didn't want to actually get serious about buying until early this year. So it was right around the holiday time that they reemerged and said, "Okay, we're ready to go." Well, then I found out the rest of the story. By pulling their credit and so forth, because they didn't want me to pull their credit back, last summer. Well, they were living for their other consumer debt already. That gets into this whole DTI issue. We have just now got to a level where the average car payment is $800 a month. That's for one car. Now, a lot of couples, there are probably two of those. So then suddenly you're at $1,600 a month. The average student loan debt, $300 to $400 a month. The average credit card debt I read is like $300 to $400 a month. I would argue, no, it's more than that. So you put those together and you say, well, wait a minute, that's a couple thousand a month. And I haven't even entertained the idea of getting a mortgage. So then when you realize, when you hear that saying of, I don't want to be married to my mortgage payment, well, you may be right, because you can't be married to the mortgage payment because you're already married to your car payment, your student loan payment, your credit card payment. So you've got to kind of divorce yourself somewhat from those payments so that you can marry more of a mortgage payment. But yeah, you can decide what's affordable for you. Again, it gets back to that reallocation of your dollars. I don't quite comprehend. I'm going to sound like an old guy that I'm lecturing. I don't understand, when 1 in 5 car loans or car loan payments are $1,000 a month.
That's insane.
You're spending that kind of dollars per month for an asset. You can call it an asset that's depreciating. By the time you finish your 84-month payment schedule, that car is going to be worth a third of what you paid for it. I don't understand that logic, but I guess cars are more important to some people than homes. I don't know how you can make that conclusion when you consider all the benefits we went over earlier. So that's why I think we have this scenario where folks need to reallocate, readjust their balance sheet, and prioritize what's important long term for them and their family, and make those changes to be able to buy a home and do so comfortably.
Yeah. Well, there's the whole thing about educating first-time buyers about post-purchase spending. We talk about how do we get here, and we've been here. We buy the house. We got to have the furniture. We got to have the new refrigerator. We got to have the new stove. And next thing you know, we have really kind of, even if we didn't have the new car, we've backed ourselves into a budget corner.
Well, right. And, that's the other thing we always try to warn, especially first-time home buyers. Buying the home is just really the start of the journey, right? And that's why it's so important that you kind of reposition your monthly budget, rebalance your balance sheet, and be prepared for not just acquiring the home, but what's involved after you acquire it. It's not just we're talking maintenance and repairs. Almost every time I close a mortgage or we're getting ready to close it, in fact, I just had it happen again last week. Hey, it's President's Day weekend. There's all kinds of sales out there for furniture and appliances, and they're not closing until this week. It's like, is it okay if we go out and buy stuff for our new home? Well, of course, I said, wait, hold off, because lenders monitor that until they fund the loan. So you don't want to get caught up in that. But it's an example of how after you buy, then you're going to spend even more dollars to furnish it and spruce it up and do all the things you want to do to it. And guess what happens there? A lot of times it gets put on consumer debt, credit cards, and so forth. And so then you're putting more pressure on that one speed bump away. So I always encourage people, I run into a lot too, that say, well, I'm not ready to buy. I want to save up enough to have a 20% down payment. I tell people, look, let me help you. Let me look at what your financial profile is. Let me see what your other consumer debt is, because I can help you and show you specific numbers where it would make more sense. Don't focus on a 20% down deal. Maybe go 5%. You want to keep saving that money, or maybe you already have. don't use it toward the down payment. Pay off all this other debt. So that way you are going to be able to comfortably afford the mortgage, even with that higher down payment, because the reduction of that other debt is going to be better from a household cash flow situation than that higher loan amount. And then that way you're also positioning yourself to be able to more comfortably have more expenditures for the home in terms of furnishings and so forth after you acquire it. So that's really how I see people should strategize, because it'll help them get that other debt down, which of course is going to help them with what? The DTI, the debt to income ratio. People don't realize that they oftentimes can afford and be qualified for the higher loan amount if they can get rid of that other debt, because that other debt in terms of monthly numbers is much higher than that higher loan amount from the smaller down payment. So that's the way you can, in a practical way, address the DTI issue.
I love that. Well, this has been a very good conversation, and I hope that makes sense now what DTI is and why you should care if you're a consumer out there and you're thinking about buying a home, of what you should do. Art, as always, I really appreciate it. I'm gonna jump out here and let you finish up the show, and we'll see you on the other side. Thank you.
Okay, thank you, Jeff. All right, excuse me, everyone. All right, let's finish up here. We've gone a little long on the program, but I think we had a good discussion, Jeff and I. What I want to talk to you about real quick, I talked about this, believe it or not, last April of 2025. And this is a loan program that I think needs to be paid attention to, the FHA 5-1 ARM. I consider it the best ARM loan program on the market. Again, ARM loan, adjustable rate mortgage. Recent shifts in the bond market, the mortgage market, has created an opportunity for home buyers. You can now get an FHA ARM 5-1, and what that means is it's fixed for 5 years. You can get one right now with a start rate at 4 3/4 with no points. That's tremendous for anybody who's worried about rates. How could you not be interested in being able to buy a home and get a payment based on a rate at 4 3/4 that's fixed for 5 years? What happens? Fixed for 5 years, then it adjusts every year. There's a 1% cap on those adjustments. So in the first adjustment, year 6, you're limited to a 1% increase if that is necessary. Then each subsequent adjustment for the remaining 25 years, you're capped at 1%. And of course, that would only happen if the index plus the margin keeps going up and up and up. That's usually not going to happen. Then overall, for the life of the loan, you've got a 5% life cap. So if you start off at 4 3/4, you know, no matter what, over 30 years, you'll never get into double digits because of that 5% life cap. And here's the kicker. The FHA ARM, unlike any other ARM program on the market, conventional, jumbo, and so forth, you qualify at the start rate. We just talked about debt to income ratio. The 5-1 FHA ARM has the huge benefit of, at 4 3/4, your qualifying debt ratios based on that rate, even though it'll start adjusting in year 6. That is a tremendous benefit to a prospective home buyer and gives you more purchasing power as to loan amount. Now, we can't do temporary buy downs on a 5-1 ARM, but we can do permanent rate buy downs. And consider this, I mentioned before, in our market, I think in most markets, the ratio of list price to actual closing price is about 3%. In other words, most homes on average are going to close at about 97% of the original list price. Well, consider doing what I've mentioned before, make an offer at full price, ask for 3% of that price as a credit from the seller in dollars. You can then use that credit to permanently buy down one of these 5-1 ARMs. So you will have a rate in the 3s, like 3 5/8 for 5 years. How could you not consider that something to look at as a way to get into home ownership in an affordable fashion? Now, finally, FHA loans, you do have to be a primary resident. You have to buy the home as your primary resident. It can't be a second home, can't be a rental property. And the other thing, again, misconception, you do not have to be a first-time home buyer. FHA does not require you to be a first-time home buyer. So you can use this program even if you owned a home before, or if you own a home now and you're looking to sell it and buy another, then you could actually get this program. And based on the county limit where you live or where you want to buy, you can buy that home with 3.5% and get the rates this low in the 4s or possibly 3s if you negotiate a concession. So I just want you to be aware of that. It's a great program. If you want more information, excuse me, please call me, contact me. Be happy to give you a worksheet and give you some numbers. So with that, that'll conclude this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. I feel like I'm losing my voice. So long. Take care. We'll see you next week on the next edition of the Mortgage Minute.